Hey, cash flow maximizers. Today, we're going to go over an infinite banking policy and a number of different ways that we can design them based on your needs.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Let's get into this. We have 4 different designs that we're going to go over in this video. I've got them listed right here. We've got our base premium, which is $1,800 a year, base premium plus $300 in paid up additions, which is our minimum number in paid up additions. Then we've got design number 2, which is we put in $18,000 a year for 7 years, and then we turn it into a reduced paid up option. This is usually the best option if you want to just put in for a set number of years, in this case 7 years, and maximize those dollars. With this design, we can minimize the amount of insurance that we're buying to do this policy, to put $18,000 a year in, and maximize the cash value for each of those 7 years. Design number 3 is going to be $18,000 per year in, and then $2,100 a year after that. Now, the reason we're illustrating that one is because if we set up this policy like we want to design it to do 7 years and then reduce paid up, but then you hit that 7 years and you decide you want to keep paying into it. Design number 3 is how that would look. So you don't have to actually turn the policy into a reduced paid up on year 7. If for some reason you want to keep making premium payments, you have the ability to continue making premium payments with this design. Now, design number 4 is going to be $18,000 a year in for 15 years, and then $2,100 a year after that. The reason for this design, what we did is we maximized the insurance that we're able to purchase, which extends the amount of years that we can put in that $18,000. So when I'm looking at designing these policies, we can design it anywhere from 7 years to 15 years to be able to put in that full amount and nuzzle up close to that MEC limit. So let's take a look and see what those look like. So with the spreadsheet that you see here, we've got year 1. This is for a 35-year-old male. And we go all the way down to age 85, which happens to be year 51 for this person. Okay, so let's look and see what happens here. If he decides to set up this policy and just minimum fund it with the base premium and the paid up additions, this is what it ends up looking like. You can see our annual outlay, $2,100 a year. Then we've got our annual outlay cumulative. So this is that $2,100 added up year after year after year. We put this in here so that we can keep track of our cash value and when it's going to break even. So in this policy design, we don't start off with much cash value, and it actually never breaks even. Now that coincides with the cost of our insurance. So our insurance is $670,000. This is what allows me to create a policy with an $18,000 MEC limit, or real close to $18,000 MEC limit, so that we can deposit $18,000 year after year. In this scenario, the person is opted not to do that for some reason. Now, if you're the client and you end up wanting to do something like this, I would not want you to buy this policy, okay? I do not recommend this if you're planning on minimum funding these policies. The success of these policies is in the max funding of them, getting as close to that MEC limit as possible so that most of our premiums that we pay go to paid up additions, which turns right into cash value. Now you can see in this one, we don't generate much cash value and it never breaks even. Now this cost of insurance, because we utilize 1-year term in order to make up the amount of insurance that we need above the base premium, In this case, it never drops off. We have to start cutting back the amount of insurance that we have, even though we didn't get up where we needed to be. So we never did end up breaking even, and the amount of insurance that we're buying went way, way down because our costs are now exceeding the performance of the policy. Okay. And way down here at age 85, we've put in $107,000. The cash value is only $96,000, and the amount of insurance we have is $155,000. Terrible, terrible performance, but clearly that is not what we were going for. Okay. This is worst case scenario. You sign up for the policy and then suddenly you don't ever overfund it. Now, let's go to scenario number 2. Here's where it gets a lot better. Okay, scenario number 2, we're putting in $18,000 a year for 7 years, and then we're going to turn off the premiums. We call that a reduced paid up option. This is where you tell the insurance company, I don't want to make any more premiums. I don't want to be charged for any more premiums. And however much cash value I have there, we're going to turn that into a certain amount of insurance, and I'm not going to put any more money into the policy from then on. Now, your policy will still perform. You'll still get dividends every year, and those dividends will still continue to buy paid up additions. You just can't add any on top of that. So in this column, we've got $18,000 a year going in for 7 years. Here's our cumulative total. $126,000 is what we end up putting in total. And here's our cash value. You can see here I highlighted the break-even year. This is year 4. And we end up with more cash value than we've paid in premiums. Now our death benefit, $670,000. Same as in scenario 1, but this time we've max funded this. So what happens is when we turn this into a reduced paid up option, our death benefit drops a little bit because this is what we've paid for completely. But our cash value, you can see, is still going to continue going up. Even though we've stopped putting in money, our cash value goes up, our death benefit goes up. And if we go down to age 85, we still haven't put any more money into it. We are at $126,000 that we put into it. Cash value is now $690,000, and our death benefit is up to $845,000. So pretty good performance there on $126,000 that you put into the policy. And throughout all of this time, you have access to this cash value. Okay. You can put money in, you can take it out, you can borrow against it, and it's going to continue to grow. The idea is we're going to continue putting money back into the policy, though, so that it performs how we expect it to perform. Moving on, let's look at scenario number 3. Scenario number 3, recall, we put in $18,000 for 7 years, and then we're going to drop that down. At this point, we go $3,600 for a few years, and then it's $2,100 is what we can put in. So this is the most that you're able to put in without making this mech at some point in the policy. When you're actually going through this policy, these are things that you can adjust year to year. We can look and see how much are you able to put into it without exceeding the mech. In this case, I just designed it with a design that shows you what you can put in if you never want it to become a mech and you never want to turn it into a reduced paid up option. You can actually put in more in these years, and if you tried to put the 2,100 in year after year after year, eventually it would turn into a mech at some point if we did it that way. So if you wanted to put more money in earlier, you can. We would just plan on turning it into a reduced paid up option before the policy mechs out. Okay. So hopefully that makes sense. But the idea is with this design, this is something where you can continue to put money in year after year after year. Okay. So our next column, we've got $18,000 a year. You can see it adding up. And then it slows down, but we continue to put money into it. So you can see it continue to grow. 2,100 each year, year after year. You can see our cash value generated here. First year cash value, exactly the same as over here. In fact, years 1 through 7, everything is exactly the same. Okay. Death benefit, all the same. The difference is after that, we're going to continue putting money into it instead of turning it into a reduced paid up option. So in this case, it's going to continue to grow along with the premiums that we continue to put into it. But obviously, it's going to start generating more money than the other policy. The difference is you're no longer putting in the extra paid up additions. Remember, when it comes to a whole life policy, your base premium in this case is $1,800. So you're only putting in $300 more than the base premium. That means you're barely covering expenses as you're continuing to put money into this policy, because the expenses in a whole life policy are year after year after year. They're set year after year after year. So most of this 2,100 is just covering the maintenance. Okay. You will end up making more because we broke even way up here. You're still making more than you're putting into it, but it's not as efficient as the money we put in at the very beginning. Okay. Now, that doesn't mean that it's a bad thing to do. If you end up in a situation where you can't get another policy for some reason, you may want to keep putting money into this policy the most that you can. If you end up in a situation where you just have extra money and you don't have anything better to do with it, rather than putting it in your checking account, you could be putting it into this policy and having the death benefit and the cash value continue to grow. It does still perform. It just doesn't perform as well as the first 7 years of this policy. So let's see what that looks like. We'll come down here to age 85. And you can see we've put in $222,000 total as opposed to $126,000. Our cash value is now $891,000. And our death benefit, you can see $1,083,000. So we've definitely got some benefit out of this. Almost $100,000 more that we paid into it, and almost $200,000 more in cash value. So if we do a little bit of math here, in this instance, we turned $126,000 into almost $700,000. In this instance, that extra $100,000 only translated into another $100,000 in cash value. So you can see how it's not maximizing your cash flow. So when I talk to people about designing these policies and trying to figure out how much you want to put into it for how long, oftentimes we'll talk about doing multiple policies. We wouldn't start the multiple policies today, but we might start a policy today. And then once you get comfortable with it and you figure out if you can deposit more or you can handle higher premiums, we might open up another policy next year or in a couple of years or whatever the case may be, as long as you're still able to qualify for life insurance. That's the key to this. Now, if you're in a situation where you're getting older, you may anticipate having some health issues that might make it tough. We may want to do a different design and try and maximize how many years we can put into this. So instead of shooting for that 7-year maximization, we might shoot for a 15-year maximization, which you'll see in scenario number 4. So let's take a look at that one. So here we have scenario number 4, our annual outlay. Now, for some reason, it kicked up $147, but that's okay. What I did was I went to the maximum amount of insurance that we can put in and still keep it at $18,000 a year. This allows us to extend the number of years that we're going to pay that in. So you can see here, we went 15 years. Then we had 1 year where we couldn't quite do 18,000. We could do 16,000. And then it drops down to those few years where we can get 3,600 in, and then it drops down to the base premium of 2,100. Now, here's our cash outlay. You can see over those 15 years, we end up putting in 280,000 before it drops way down. And our cash value, almost the same. You're going to see a little bit reduced because we're paying for a lot more insurance. See this? 1.2 million insurance here, 670,000 here. The difference, it's about $70 for these first couple of years, $70 difference. So we're going to see the cash value growth change here. It's about $140 less. And then the insurance cost goes up a little bit more. And so we're a little bit less. So this moves our break-in period to year 5. And I have that highlighted right here. So our break-in period is year 5. Year 5, we're at 91,000, whereas we were at 92,000 in year 5 when we paid for less insurance. Now, the big difference though is we got a lot more years that we were able to put in $18,000. So we're going to see this start to go way, way up. Now, what does that mean when we get down to age 85? We get down to age 85. Now you can see we've paid in $365,000 as opposed to $222,000 on this side and $126,000 from the first scenario. And what does this do for cash value? Look at this, $1,400,000. That's quite a big jump. So in this case, we put in $200,000 and that turned into an extra $800,000. That's a pretty good return on our money, okay? It's not quite as good as the very first scenario, okay, where we maximized it by minimizing our insurance cost and paying in for 7 years and turning off our premiums. This does pretty well though. Now, keep in mind, we can also turn this into a reduced paid up as soon as those $18,000 charges come off of that. But check out our death benefit. We're at 1.7 million now for a death benefit. This is not a bad scenario. It's actually a very, very good scenario, even though we didn't quite maximize our cash value by minimizing those insurance costs. We actually maximized our insurance cost so that we could continue to put more money into it in later years. Whichever scenario you decide to go with is up to you. It's going to be based on what we anticipate you having available and, of course, your health. So if you're a fairly young person, in this case, this person is 35. He's very healthy, and we are assuming he's going to continue to be healthy at least for the next year or two. And we're also anticipating that his income will continue to grow because he's investing in real estate. He's got a number of avenues ahead of him to continue to see his income grow. So we fully anticipate that he would want to get another policy maybe next year or the year after that. So in this case, I would probably go with the first scenario. But there's also another reason that I would go with the first scenario. When it comes to how we design these policies and how much money you can put into them, the amount of insurance that you can qualify for makes a big difference. So in this case, we've got two different options that we've shown. We showed maximizing the insurance and minimizing the insurance. Minimizing the insurance, we're at $670,000. Maximizing the insurance, we're at $1.2 million. Let's say that the insurance company looks at your financial situation and says, okay, the most we're going to allow you to buy for insurance is $1.5 million. We can, if we don't anticipate his income going up, we can use almost all of that here, maximizing the policy and planning to pay in $18,000 a year for the next 15 years. Or we can go with a minimum design policy, which number 2 here, design number 2, minimum design policy, put that $18,000 in for the first 7 years. And at any point in here, we can open up another policy and do another $670,000. So he can end up putting in Another 18,000, it would just be in a different policy. So let's say he started that policy here right after this one ends. He would still end up getting 14 years of $18,000 going into a policy. He would just have this policy growing and maximizing, and another policy growing and maximizing. How that ends up? Probably fairly similar, okay? Probably fairly similar, because a lot of this depends on how much cash you're actually putting into these policies. I think you'll end up being in a better situation doing multiple ones of scenario 2, where we turn it into a reduced paid up option, as opposed to just doing one of the scenario 4s. These are things that you have to decide, along with consultation, of course. I mean, these are the things that we want to talk about. So there's no cookie cutter approach. When I talk with my clients, we look at your situation, what you anticipate wanting to do, and we just try and design this so that it's going to fit your situation the best. So I hope that makes sense to you. I will be back with another one of these in a couple of days. I've got one where we're going over a very similar scenario for another client, only I'm doing 7 different designs, and in this one I'm including the index option. With the stock market tanking quite a bit, we've got people who are interested in using the index option that Guardian offers. So we will talk a little bit about that in the next video. If you found value in this video, give me a like, subscribe to the channel if you want to follow along. Thanks for watching.